Bajaj Auto posted a mixed set of numbers for the quarter ended December 2018. Let's do a 3-point analysis on understanding what led to that performance and the outlook going forward. First, what were the key positive from the result? The company posted a revenue growth of around 16.5% as compared to the same quarter last year. This was primarily driven by 25.8% growth in its volume. The domestic volume grew by around 27.5% and the export volume grew by around 23.5%. The growth in the domestic volume came on the back of the price cut taken by the company in its entry-level motorcycle segment. Three-wheeler, on the other hand, witnessed a decline primarily because of the large base of last year. On the other hand, export market continued to do well both on the front of motorcycle and three-wheeler segments. Second, what were the key negatives from the result? What is challenging for the company is to arrest the fall in its EBITDA margin, which came at around 15.6% and contracted by more than 370 basis points as compared to the same quarter last year. This was primarily because of two factors. First is the decline in realization, and second is the significant rise in raw material prices. Realization declined primarily because of the unfavorable product mix and the price cut taken by the company in its entry-level bike segment. Third, what is the outlook for the company? The company continues to gain market share on the back of its aggressive pricing strategy. Its market share came at around 20.3% in this quarter as compared to 18.6% in the last quarter. The management indicates that the EBITDA margin should improve going forward, primarily because of the favorable product mix and inclusion of premium products and the depreciating rupee. And the next is the three-wheeler market continues to be very robust on the back of the end of permit raj and the issue of the new permits. And apart from that, the government has allowed the use of alternate fuel, where the Bajaj Auto is a leader with a market share of around 85%. And finally, the export market continued to do well, which should augur well for the company, primarily because it generates around 40% of its volume from there. The company has around 45% market share in the Africa and 68% market share in Nigeria. Overall, the company is in good place, and the stock has corrected by more than 40%, which makes the valuation very reasonable. We advise investors to accumulate in a staggered manner. Thank you.